Welcome back to another episode of the Market Open live stream. Today, we actually won't be hitting the Market Open live stream because I gotta fly. But what we are going to do is start a little bit earlier here. And we gotta start with Tesla. I mean, obviously, the sucker's down, 8-9% or something here. So the straddles should pay off. Let's see how the pre-market's doing. Yeah, 8.5%. I don't know, Weeble's glitching out here. 8.5%. We'll see how it moves by open, but some short-dated straddles should show some dollars. Certainly not the call portion, but anyway, that'll be zero. But the put portion should move nicely. So we'll see what happens. Now, as far as what we've got with Tesla longer term, I really think. Oh, well, let's fix that. There we go. All right, let's get the better microphone. That helps. So one of the things that I always look at is look at Tesla as just a car company with the potential of FSD. This is what we did in my analysis where I said beware of the Tesla rug pull. And the company, it makes sense even as just a car company. Unfortunately, it's a higher peg. And it has been a higher peg, right? It's just a car company. Factor in some FSD revenue. You're trading somewhere between 2.0 basically and 2.5 peg. I usually underwrite Tesla at about 1.67. So now, it's possible Tesla could trade for a higher peg, but what it would mean is that you've got a lower growth multiple. And I think that's unfortunately what the market's just pricing in here. Though the street estimates haven't really been revised yet. We look at EPS for the trailing 12 months sitting at about 2.6. That was substantially below what expectations were for 2023. 2023 expectations were somewhere for almost 90 cents of more EPS for this company, which that's a big miss. Somebody here says Tesla is a joke market cap wise. See, that's incorrect because they make enough money to justify a market cap that is in excess of certainly $500 billion. And the reason for that is simply they do have enough cash from operations to where a company of this magnitude would be expected to essentially print $4.5 billion of cash flow a freaking quarter. It's a cash flow machine. The problem is the growth forecasts. That's what Tesla moves on. And that's what Tesla didn't give us today. Or yesterday. That's a giant pisser for them to completely ignore growth production is definitely a problem. A lot of folks were looking at, Wall Street certainly was looking at this as a company that was going to show 2.18 million vehicle deliveries. That, was certainly lower than a lot of estimates, including my own. But even that would have been better than, it's just going to be lower. Oh, how much lower? Next question. Unfortunately, that does mean you're probably going to get some growth revisions here in the days after the Tesla earnings release, which right now, it's worth noting what Wall Street projects. This is not what Kevin projects. This is what Wall Street projects. Wall Street's projections right now for Tesla growth, and it honestly might be easier to achieve this given how low earnings per share are now. This could end up being a bottom for earnings per share comps, but you go 33, 36.3, 30.9, 38.8, and 28.5. That's 5 years of earnings per share growth. 5 years of earnings per share growth. You're looking at 33.75%, 33.5% on expected EPS growth over the next 5 years, which frankly, I don't think anybody disagrees that there will be substantial EPS growth for this company in the future. I think the pisser is when? How long is it going to take to get there? And how many bankruptcies are there going to be before that? So obviously joking, but it's something where like the future of the company isn't at stake. What it is the near term. It's kind of honestly Tesla. I was thinking about this yesterday. Tesla trades like a call option on interest rates. So when it looks like interest rates are not moving in a favorable direction for Tesla, the underlying stock moves very dramatically, very much like a call option. And like owning Tesla is almost as toxic for like your mental health as owning a short dated option, because one moment you're a king, the next moment you're a bum. It's really incredible. So it how should I say, it requires some insane mental fortitude, which I actually don't think most people are going to maintain for a stock like this. I mean, to some extent, why not just be in a stock like Nvidia? Oh, well, look, Nvidia's up another 1.5 in pre-market. And part of that is probably because Elon kind of folded on Dojo and just admitted that Nvidia is God. So, yeah, it's certainly going to, I think, drive a substantial amount of frustration. Do note that each of the last 3 earnings, Tesla dropped 9%. The stock's basically down 9% right now. So right now we're just getting to where this is in line with normalcy. And given that, again, on a technical basis, we're going to be 189, we're going to be right about here where my mouse is when the market opens. There's still that downside risk of a bounce at 174. Keep in mind that 174, I think you're probably going to get a lot of people who front run this stock. So if people front run this stock, you probably could start seeing some buying around the 180 even number. 180 even buys, depending on investor appetite, obviously. 180 buys could drive this right back to about 221. We'll see. Nobody knows. But yeah. I mean, the patience required to hold essentially call options on these interest rate sensitive stocks like Enphase and Tesla is an order of a magnitude greater than anything else that would be required in whether it's certainly real estate. I mean, real estate's like easy compared to this. And then of course, whether it's index based or even just the chip sector as a whole, anything other than the interest rate sensitives. So again, if you own it, think about it as a call option on interest rates. I think that's just the easiest way to understand it and to look at it. Okay, good. So let's now take a peek at what else is going on. We have the Fed buy the dip program, it's the Bank Term Funding Program. The Fed's Bank Term Funding Program had an update yesterday that essentially the program will be ending on schedule, as expected. Well, I mean, I actually thought they would have extended the program, but as the Fed had expected. The Fed had expected to end the program. Sure enough, Fed program for the Bank Term Funding Program is ending. It's worth noting that Fed program essentially removed about 2 months of quantitative tightening from markets. Remember that you had about $160 billion flow into the Fed's Bank Term Funding Program. Well, that's a lot of money going into the bank program. And the money that goes into the bank term program is basically just liquidity, right? Bank Term Funding Program. All right, here we go. So we take a look at this. Bank Term Funding Program. Here we go. Okay, what's going on? And here it is. Okay, perfect. So let's see here. Okay, there we go. Okay. Bank Term Funding Program, we take a look at this. We can see the explosion in the Bank Term Funding Program. Specifically, though, look at the right side here. The Bank Term Funding Programs run from about $113 billion to about 161. The 161 is pretty remarkable. I mean, this isn't. Yesterday I thought it was 161. It's actually showing 154 right now. But anyway, this is about an increase of roughly $40 billion. That's about half a month of quantitative tightening that was just essentially undone. So you're like the Fed's kind of going in the wrong direction on that Bank Term Funding Program. And so I think that's one of the big motivating factors for saying, you know what, we need to pause this program and essentially stop the use of the program. And so the program will end in March. What's remarkable, though, about the program is There was recently, and George Gammon and I talked about this on the interview on my channel. You should watch it if you haven't seen it yet. But the Fed's Bank Term Funding Program offered this bizarre rate arbitrage. Even if it's quite frankly only about 40 basis points on something like $50 billion, you're still talking about a massive amount of money, annually. So take a spread on 40 bill. Let's run it here. 40 bill. And it's just an extra 40 bill, right? The new inflows. And let's say you're at 40 basis points. 40 basis points at 40 would put you at $160 million of essentially extra profits just in taking advantage of a spread here. Now, obviously, that's not just going to be one entity, but the argument here is to show that, there was a lot of money to be made on an arbitrage play. People took advantage of it, and the Fed's like, wait. That's not what this is for. So the Fed essentially raised the rate on the Bank Term Funding Program and to essentially put a stop to the arbitrage. So it's not an incredibly big deal. But what I think a bigger deal will be what happens when what happens when and if banks need the Bank Term Funding Program and it's not available anymore. I almost think the Fed will be more likely to cut in March with this program not being extended. It's interesting.
Great. Always good to see you, sir. Appreciate it.
Thank you, Andrew.
Okay, they're kicking this guy off. So that's an interesting thought. I mean, right now the market's only pricing in like a 42% chance of a rate cut in March, but I think the end of that Bank Term Funding Program could otherwise start leading to stress again in the banking market if they don't loosen financial conditions for via yields. But we'll see. And yeah. So that'll be really interesting. Let me see if I can get some more details here. So I want to see this. Let's see. Fed. See. Wow, the spread was even bigger. This is the Bank Term Funding Program. I think it's worth having a screening of this right here because it shows you the Bank Term Funding Program and just the amount of movement that we've seen in the program. Really just, again, frankly, since about December, the spread has been this wide. And so, again, the Fed's closing down that spread. But I thought it was maybe a 25 to 40 basis point spread. Looking at the actual, the spread got as wide as 54 basis points. So totally makes sense that people are arbing that market. And you kind of can't blame it. So can't blame the Fed here closing the door to that either. That's not what the program was designed for. But again, if the program door closes, I mean, I know you can adjust how the rate system is structured, which they did. But if the program door closes, that means banks have essentially lost their new lifeline. So it's kind of like, get in before the program's over between now and, 6 weeks from now. So I find this very interesting. Program stops funding new borrowing March 11th, 2024. I'm going to make a little note. My concern is what happens with banks after March 11th who need a rescue loan. Banking crisis 2.0 is possible unless, and this is what I think is more likely, which I don't know. I'm honestly I've been more towards no rate cut in March, but for me, this tilts me in favor of a March rate cut. Why? It would signal essentially it would signal to markets, hey, it's okay to start loosening, right? It signal that it's okay to start loosening. So that's my take on the Bank Term Funding Program. I don't know. We'll see. But that Bank Term Funding Program, some people were concerned yesterday hearing about the Fed sort of changing the rates on this. None of that is a big deal. That's just ending the ARB opportunity. That's not a big deal. The program's not there to give people that. 52 basis point spread for free. The program's there to help banks in need of emergency funding by being able to collateralize their treasuries at 100%. So, yeah. All right, let's listen in here for a moment.
Interest rates unchanged. And they do say, though, that aside from an energy-related upward base effect on headline inflation, declining trends in underlying inflation have continued, and past interest rate increases keep being transmitted into financing conditions. So relatively happy with where they are now. Based on their current assessment, they consider that interest rates are at levels that they're keeping that language for a sufficiently long period of time, will make a substantial contribution to the goal of reducing inflation. You'll remember that there's discussion about whether or not the ECB might cut in the summer. There's about 100, or there were before this announcement, at 130 basis points of cuts built in to ECB futures for this year. So we'll see if that changes. One other line here, they say that decisions will ensure that the policy rates will be set at sufficiently restrictive levels. So they're keeping that relatively hawkish language there, guys. I don't think that Lagarde is willing to give it up just yet. There's been pressure, and just like in the United States, guys, pushback from officials when it comes to the outlook by the market for rate cuts. Although Lagarde has said it's possible that they might cut rates in June. So we'll just leave it there, maintaining the hawkish outlook, very much like the United States, trying to put off market expectations for rate cuts, but keeping that hope alive. Becky?
Steve, thank you very much. We'll see you a little later. In the meantime, in a letter to the FAA this morning, our next guest says that the Alaska Airlines door plug blowout earlier this month underscores the need for the agency to update its rules on cockpit voice recorders. Specifically, he wants a broad rule for planes to have 25 hours of recording time instead of just a few that they have at this point in most cases. For more, we want to welcome Connecticut Democratic Senator Richard Blumenthal. And sir, thanks for being here.
Thank you very much for having me. Good morning.
Before we get specifically to the letter, just get your thoughts, because you have been pretty vocal about what's happened with the Boeing situation, with the Alaska Airlines, with the door plug blowing out. Do you think that we're doing enough to oversee all of this at the FAA?
You know, the letter that I'm writing calling for the 25-hour minimum requirement for the voice recorder is only one example of recommendations made by the NTSB and other safety advocates that have not been followed. So the answer to your question is very simply no, we're not doing enough about airline safety. And I have grave reservations about putting these planes back in the air so long as there is not sufficient oversight, independent scrutiny over the inspection process that the FAA has said it will implement, and other aspects of airline production at Boeing. We've relied on the fox to guard the hen house all too long.
Meaning you wouldn't put these planes back into place, even though the airlines that purchased those planes have kind of gone over this with a fine-tooth comb, it seems, at this point. It seems like we might see some of those planes back in the air for Alaska Airlines as early as tomorrow, and by Sunday for United. It's not enough that they've gone over all of these things, too?
We need to be assured the traveling public needs that guarantee that even the airlines have been overseen by the FAA, and we need to know also from the NTSB, which is investigating, what the cause was. I want to hear from...
Yeah, all right. Duh. All right, so I do want to look, I mean, we saw a little coverage here on the ECSB. I want to look at some quotes here. So, again, we know that they held rates steady, held rates as expected. Honestly, I don't think this is for the main refinancing rate is 4.5%. I don't think the ECB is actually going to cut anytime before the Fed. I think the Fed goes first here. And so we'll see. I think most central banks around the world, I would expect, are going to follow the Fed, not lead the Fed, maybe with the exception of like Australia. But anyway, let's see. Let's see. Rate level to make substantial contribution to reaching 2%. We've got reiterates plan to start reducing this runoff. That's fine. To set sufficiently restrictive policy as long as needed. We've got declining trend in underlying inflation has continued. Okay, well, that's good. Declining trend in underlying inflation has continued. And information broadly confirmed prior inflation estimate. That's also good. Broadly confirmed prior inflation assessment is actually the way they wrote that. Okay, then we have price outlook, underlying dynamics and transmission are key. Tight financing conditions are dampening demand. Dampening demand is helping push inflation down. Well, yeah, no kidding. ECB will continue to follow a data-dependent approach. That's pretty boring and pretty expected. Oh, and wake the TV up. All right.
Common sense, doesn't it? Is only one of about 40 that have not been implemented. 40 recommendations for airline safety from the NTSB and other safety advocates that still are not implemented. And I think that goes to the real system that we have right now for airline safety, which has proved inadequate again and again.
So your point is the NTSB makes recommendations. The manufacturers or the airlines can choose to disregard them if they want to, and we're still winding up with situations like this?
And it's not only the airlines and the manufacturers that can disregard them, but also the FAA. And that's part of the problem, that the agency that is supposed to safeguard safety is, in effect, ignoring or disregarding the recommendations from the safety advocates.
The street is looking at what the FAA is requiring of Boeing at this point to say that you are not going to be allowed to increase your manufacturing until we get in there and take a deeper look at that. And they think that that is a pretty strong action from the FAA. You disagree?
I agree. It is strong action.
Okay, we're going to pull off this. The politics stuff always bothers me. I mean, some of this is interesting. Getting a little snippet update on what's going on with Boeing. But what's more interesting to me is actually what's going to come out in about 8 minutes. We're looking for a GDP action. Now, this is going to be GDP Q4. Q4, this is the advance read, which means it's essentially the first of 3. So we'll get GDP advance, revision, final. And we'll get the first today. We're looking for GDP annualized of 2%, GDP price index of 2.2%. Then we are looking for, let's look at the Atlanta Fed for a moment on GDP now. And while we do, though, wow, okay, 2.4% as of the last estimate yesterday. Sorry, not yesterday, on the 19th. Well, that's also kind of wild. Take a look at this. So, and the Atlanta Fed has been pretty on it in terms of GDP. I mean, I don't want to see the GDP decline, especially since we're watching layoffs as much as we are. I've been posting on eHack the layoffs tracker, and mostly we're curious to see how January is going to end up relative to last year. And it does feel like it's getting a little bit more aggressive for January. But the month isn't over yet, so we don't have the full set of reports yet. But let me see if I can get the latest picture here. Okay, we'll just go ahead and jump to eHack, which is the easiest way to do it. So here on eHack, you can see where I've already put the notes regarding the bank term funding program. And then we have a Tesla talk from yesterday. We got the eBay, Wells Fargo. Here it is, Wednesday morning. This is the True Up. TrueUp.io/layoffs shows you this. Let me see what the number is today. TrueUp.io/layoffs. See, sometimes I even forget the website, and I just go to eHack to look. Oh, yeah, it's only like 200 more right now, so it's 32,626. I'm just worried that, January is going to end up starting to look something like these numbers over here. Who knows? Maybe not. Maybe not. So we'll see. Anywho, again, that's eHack.com. All right, so again, we're going into PCE here within 5 minutes. We'll get an addition. Let's see, today's Thursday, so we should be getting initial claims as well. We are. Oh, wow, okay, we're going to get a lot. So we're going to get GDP, retail inventories, wholesale inventories, durable good orders like cars, durables X transportation like washing machines. And then we'll get capital good orders for non-defensives, excluding air. And then we'll look at initial jobless claims, continuing jobless claims, new home sales. And yeah, but the new home sales won't come out until 7 a.m. So, yeah. Yeah, possibly. This is a good question. Well, I think Elon slightly hinted at the number. He's like, hey, you know, as of Q4, we were essentially building Teslas at a 4 or at a 2 million car rate. You know, that would be somewhere. I mean, think about it. If you got to 2, I mean, it'd be the lowest estimate out of all. But you're looking at about 10% growth. Yeah. So there's definitely a growth issue when it comes to manufacturing expansion. And so to stay in the stock, you have to believe that you're just between two S curves. So, you know, that's and that you want a call option on interest rates. That's what you got. And you probably wish you had a put option on interest rates. So anyway, let's see what we've got. What's moving here in the morning? I want to see Ulta. Ulta's kind of been trading a little bit in sideways here, and this is a slightly minor downtrend. Then I want to look at how's Carnival. I know they got rejected at about 1968, and they've kind of been down since then. Yeah, look at that. They're still sitting down here. Basically had a double top on Carnival Cruise Lines. Not great. How's Coinbase doing this morning? Ooh, still sitting at about 121. Yeah, my thesis on this was short at ETF approval, pretty close to it, and then buy back in at 118. That's what I posted in the trade alerts. And it ended up bottoming so far at 118. I am very curious to see where it goes from here. Though, so far it looks like Bitcoin's stable at about that 39.5 to 39.9 level, which is interesting because you don't have any fibs or supports here. So, you know, one thing that's good about Tesla's lack of delivery is you're probably pricing in the worst now, right? Who knows? Maybe that's too optimistic, but you're probably you're pricing in bad now. Get down to 178 on the stock. You price in the worst. Any positive news, hopefully useful to the company throughout the year. Okay, what else? Let's see. Then we've got 2 minutes until data. We also have some problems going on, I guess, at Humana. So Humana is a company that helps people get into Medicare. They have Medicare, you know, help, I guess, people get into this, but then also shop dental, vision, hearing plans, support for Medicaid, Medicare, drug Part D programs. They got a lot of stuff here. But anyway, I guess the stock is just absolutely getting obliterated. Let me see. Humana. I haven't looked. 15%. Oh, okay. Well, that's only slightly worse than Tesla. Oh, but Humana plunges as the forecast misses, far lower than Wall Street estimates, as medical expenses and tighter government payment policies threaten insurers. Wow, even insurance is getting whacked. The only thing alive are chips. It's all right. Okay, you ready for data? Let's get the queues up while we wait for data, because there's a lot coming out right now. I want to see those initial claims. All right, here we go. And it's a coupon code expiring January 31st. Okay, initial claims 214 versus the 200 estimate, slightly higher than expected. Holy crap. GDP annualized Q on Q comes in at 3.3 versus 2.0. That's going to totally contribute to removing rate cut estimates for March. Personal consumption comes in at 2.8 versus 2.5. GDP price index, let's go. 1.5 versus 2.2. Okay, that's good. That's really, really good. Again, 1.5 versus 2.2 on the GDP price index. So stronger economy, weaker inflation. Woo, that's actually pretty good. Unemployment claims within the realm of normalcy, though 214 is certainly higher than 200. You've got durable good orders coming in flat. Why is that not a surprise to me? It's not. Durables, and the expectation was 1.5% growth. Oops. Then we've got durables ex transportation actually come in stronger. So again, washing machines doing better than cars. Not a surprise. You've got 0.6% versus the 0.2 expected. Capital good orders beat on both numbers, 0.3 and 0.1. Initial jobless claims, again, 214 versus 200. Continuing claims coming in at 1833 versus 1823. Retail inventories at 0.8, which is a higher level of retail inventories. 0.8 on retail inventories. And let's briefly listen to how angry he gets.
2%. We had 2%, that's the number, and 2% in the rearview mirror. Let's quickly go to retail inventories. We're expecting unchanged. They popped up big time, up 0.8%, up 0.8. And of course, these are the types of things that boost GDP. If you look at wholesale inventories, the same scenario. Wholesale inventories breaks 2 months negative in a row, up 0.4, up 0.4. That's the biggest increase month over month on those inventories since November of last year. Now let's go to trade, shall we? On trade, what we are seeing is minus 88.5 billion, very close to expectations. Durable goods. If you recall, last time, 5.4, that was the best since July of 2020, and that moves up to 5.5 on a revision, and the averaging takes hold, unchanged, less than expected, but when you put the 2 months together, you can see that it isn't a bad number. Ex-transportation, it jumps up to 0.6%, 3 times expectation, 1/10 higher than the rear view mirror, so we could see transportation orders boosted durable goods. And if we look at capital good orders, non-defense, ex-aircraft, a proxy for capital spending, it's up 0.3, much stronger than we were expecting. And in the rearview mirror, an upgrade from 0.8 to 1%. So to see 0.3, yes, it's a third of what we had last month, but it is still very, very solid. Shipments come in up 0.1%. And finally, initial jobless claims expected to be 200,000, pop up to 214,000. Maybe last week's 187, now revised to 189, was maybe affected by a bit of a shorter work week. 214,000, that is the biggest initial claims going back to the third week in December when it was 220,000. And finally, continuing claims, 1,833,000. That follows 1,806,000. It's a little bit higher than expectations. And if we look at interest rates, we've seen both sides trade. 10s went up to about 418 plus. They're back down to around 414. They were around 415, down a couple of basis points. That was where they were before the numbers. 2-year note yields are at 436, exactly where they were before all these.
Yeah, so no real bond market movement. But what you're noticing is look at the Nas. The NASDAQ actually rolling up here after this data. Not a surprise, though. Not a surprise. What are you getting in the NASDAQ? You're getting a reaction to stronger economy, more inventory building, more potential for greater earnings at everything except basically durables like Tesla. And you're getting weaker inflation reads all the way down to 1.5%. That's insane for the GDP price index. That's fantastic. The prior read on that, by the way, was 3.3%. So, and that's in Q3 final. So these are the GDP advanced estimates annualized. So remember, you go advanced, revised, and then final is how you get your GDP numbers. So good for the economy. Not a surprise stock market's going up on that. Not a surprise. Somebody says Tesla is going to rip. I think by rip, you mean rest in peace? Yeah, probably. Oops. Anyway, I do want to see what's moving. But yeah, you gotta price in no guide from Tesla here. So, I mean, I personally think it's a total pisser they didn't guide. So they are next to Humana, the worst performing stock right now on the day. Mobilize down 1% as well. Almost everything else is green, which is like the worst feeling ever, right? When it's like your favorite stock is negative and everything else is green. It just makes you feel stupid, right? It makes you feel like you're the problem. And it's a bad feeling. That's the problem with stocks. You know, when something feels bad, we have a fight or flight mentality. But the problem is, how do you fight? I mean, you could leave comments in the chat. That's okay, but it's not gonna make a difference. You know, it's kind of like if somebody backs you in the corner, it's like, I'm gonna kick your butt, and you're like, hold on, I gotta send a text message. This asshole's about to kick my ass. You know, that's not really fighting. And then the only other option is really fleeing. But if you do that, you've sold, right? And then you give it up. That's very normal because it stops the pain, though. It stops the feeling of misery that's associated with holding a stock that's underperforming. So very, very, very common. I think a lot of retail are going to get shaken out of Tesla. And it'll be really interesting. I think it'll always be something that people can consider coming back to, but I do think there's a chance a lot of retail, either they're already short Tesla through, you know, sold calls or puts, bought puts, or just straight up shorting. Although that's, I feel like, less common for retail, you know, or they just sell. So Qs, look at that. Qs rocketing on this GDP data. Not a surprise. So, yeah, these are some of the thoughts. Hold on, what's going on over here?
In the burgeoning consumer sentiment data, all of this points to a very robust and resilient recovery where I think the only...
Yeah, I mean, that's, gosh, this guy reminds me of Larry Kudlow. You're going to have a V-shaped recovery, everything's going to be great. Anyway, this is good. Like, it's good for the economy. Again, if you're holding interest rate sensitive stocks, unfortunately, you gotta wait. And I do think if there is some hope, up until today, I've been convinced that the Fed is not going to cut in March. But following the ending of the Bank Term Funding Program, I think there's too much risk not to cut in March. Because you end the Bank Term Funding Program March 13th, you know, you could cut a week later, and it's really going to depend on what the Treasury market does, and kind of like help banks survive without the program, without the nipple, so to speak. Or you have to wait 6 weeks. But is there a chance you get another March-April banking crisis if you don't have the Bank Term Funding Program? Maybe. So I think there's I'm personally leaning now, like, if I was probably 30%. I'm going to write this down on eHack because that way you could always track my opinion. So I'm going to put this down. Rate monitor. Okay, right now we're sitting at, I'll tell you, we are sitting at a March rate cut probability of 40. Oh, what the heck is this? Hold on. 42.3 plus 0.9. 43.2. Okay, 43.2. 43.2% chance of March 20 rate cut. And then I'm just going to document on eHack that I believed there was a 20 to 30% chance prior to the BTFP announcement. Mostly because I thought they would actually extend the program. I thought they'd extend the program. Now, I believe this creates a 70% chance of a March rate cut. So, like, I've basically completely flipped my opinion on the March rate cut because of the data of the Bank Term Funding Program. I think it's too risky to walk into another banking crisis. So, anyway, look, the data we got here, absolutely fantastic for the economy. It's good for inflation. Again, if you've got the call options on the interest rate sensitive stocks, you know, I'm sorry, drink a beer for me today. And I do, unfortunately, have to go. I have to leave early today. This is like the first time I've had to do this, but I was supposed to fly out yesterday. One of our pilots got sick, so we're flying out now. I got to get to Puerto Rico to meet Peter Schiff, and I got some work to do. So, love y'all. Sorry. And then we'll catch up on course member live streams a different time. Thank you all, and we'll see you soon. Goodbye, and good luck today.